Hey, this is Mike Carpenter again, frequently and sometimes affectionately known as Mike the Money Man. I'm a licensed mortgage broker in the state of Washington, and my license number is 111356. Presumably, if you've taken the time to sit down and meet with me and give me all your paperwork, not everybody does that at the beginning, I have enough paperwork to have created a file for you. And that file has a certain amount of paperwork in it that's associated with your file. And I've issued you a pre-approval letter, and I typically write a pre-approval letter for every offer that you make. And you can email me or call me anytime and ask for an updated pre-approval letter. But typically that pre-approval letter is tailored for your offer. For example, if you were making an offer for a purchase of $475, I'll write that letter specifically for $475. It's a 10% down or 20% down or something of that nature. But once you've gone out and you've found a house and you get an updated pre-approval letter, you make your offer, and let's say that offer gets accepted. Not all offers get accepted. But let us say for a moment that it does get accepted. That is when the action begins. So all of this has been pre-work, and this is actually work. Call it pre-work. So what happens when you get your offer accepted? One, we update your paperwork. If there's any paperwork that's missing that you haven't given to me on this side of the pre-work matrix here, we update that, and then I send you a loan application that is specific to this given offer. And I'll usually send that through a secure document signing portal called DocuSign. Once the loan application is signed through DocuSign and you've given me your updated paperwork, then we submit it to underwriting. Once I take all of this paperwork that you've given me and I submit it to underwriting, and this is when it actually goes to the lender specifically, and an actual human being looks at your file. And in this section, between underwriting and we'll call this mutual acceptance, where your contract is mutually agreed upon or mutually accepted. So between the point of mutual acceptance and underwriting, I may write a letter that is specific to your situation, to the underwriter, that explains anything unusual or anything that needs to be addressed. If there's any sort of income situation that I need to get ahead of, or any asset situation, or if there's anything unusual about where your money's coming from or anything of that nature, I sort of write something called a letter of explanation, which is addressed to the underwriter so they can see exactly how I came up with that particular calculation or particular iteration. But once it goes into underwriting, and the goal in this section is to address any potential concerns so it slips through underwriting as quickly and as easily as possible. But once it goes to a human being, it usually takes them between 1 to 3 business days to send me what they call a conditional approval. So often people ask me, is my loan approved? Well, it is conditionally approved. Conditionally approved effectively means that it's been approved pending any given conditions that the underwriter wants to see. But once it gets through underwriting, we reach a different stage where it is conditionally approved. And if I've been a good boy and done my job, there shouldn't be much in the way of conditional approvals. It might be an updated pay stub, or it might be insurance binder or an appraisal, or something like that we haven't addressed yet. And usually at the point of underwriting, at this point, this is when we request or we order quest the appraisal. Unless I've been given some specific instructions not to request the appraisal till after the home inspection is complete. Unless there is a compelling reason, I don't order the appraisal until after the home inspection is complete, because there may be some particular issue with the home inspection. But a conditionally approved loan has two types of conditions, something called a prior to doc condition and a prior to funding condition. And just as the name sounds, or the name suggests, prior to doc condition is any kind of condition that the underwriter wants to see before they issue the documents to the escrow company. And a prior to funding condition is everything that they want prior to them actually sending the money. And this is usually the point in which I contact you if I'm missing something. Say if I'm missing insurance information, or if I'm missing, say, a pay stub or something of that nature, that's when I get in touch with you. And I let you know that your loan is conditionally approved and we're moving along. But once all the prior to document conditions are signed off, we move into another stage, which I'll use another color for. I'll use green this time. So once all the prior to document conditions are signed off, the lender will issue something called a preliminary closing disclosure. And that preliminary closing disclosure has the numbers, or it's the financial part of it's a disclosure that talks about how much money you're coming in with and what your closing costs are. When we have you sign the loan application, at this point, there's something called a loan estimate. And that loan estimate is an estimate of what all your closing costs and prepaid items and down payment and all the money associated with the loan. The prior to closing, or excuse me, the preliminary closing disclosure will be almost exactly the same as the loan estimate that was issued in the loan application. And I'll go into a little bit more of that in detail. But once the preliminary closing disclosure is done, it's often not 100% accurate, but it's pretty close. But once the preliminary closing disclosure goes to you, it's emailed to you. Once it's emailed to you, you will be requested to open it. You don't necessarily always have to sign it. You just have to open it, or what they call e-acknowledge it. And that starts what's known as a 3-day waiting period. There's a mandatory 3-day waiting period. But once you open it, the 3-day waiting period starts. And after that 3-day waiting period, not including holidays or Sundays, it includes Saturdays for some reason. Once that preliminary closing disclosure is opened by you and the 3-day waiting period is over with, then you can go into escrow and sign your loan documents. People often ask me, how soon do I have to have my money available for escrow? And typically you can either wire the money in, or you can come into the escrow company with a cashier's check. The truth of the matter is that you don't actually need your money until the day that you're supposed to close. Now, every escrow company is going to tell you differently, and they're probably going to hate me for this, but typically they want you to come in with your money or a cashier's check or wire the money on the day that you sign, so they don't have to chase you around for the money. So plan on bringing in your cashier's check if you're purchasing a house on the day that you sign. But once you sign your loan documents, usually those loan documents, sign loan documents, once those loan documents are signed, typically they are sent back to the lender for review to make sure that you signed them properly. And that isn't always the case. Some lenders are what they call table funders, where they send the documents and the money at the same day, and you can sign and close on the same day. But typically, your contract has a close date, say January 15th. You would, in most instances, sign January 13th, and then those loan documents will go back to the lender, and then they will review them, and then they will fund. But let me talk to you briefly about the difference between a loan estimate and a preliminary closing disclosure. And I'm running a bit out of space, but here goes. So at the point of a loan application, the loan application has what's known as a loan estimate. And that loan estimate is usually pretty dialed in. And when I say dialed in, it is still an estimate, but it's an estimate that's fairly accurate, because as a professional, I have to make sure that I get your fees correct. Otherwise, I am responsible for those fees. The Dodd-Frank Financial Reform Act put in place rules where if I issue a loan estimate, those fees cannot, the fees that I quote on the loan estimate cannot vary within 10% between the loan estimate and the preliminary closing disclosure. Otherwise, I have to pay for it. And I'm not going to go into what fees are within the 10% tolerance and what fees are zero tolerance and what fees can change and what fees cannot. Just know that the loan estimate is pretty accurate. And it shouldn't change between the loan estimate and the preliminary closing disclosure by much. And it's not supposed to change by much. Unless there is a bona fide borrower requested change. For example, if during this entire process you come to me and say, Mike, I want to change my loan amount from $400,000 to $395,000. That is a bona fide change of circumstance. And that's when the loan estimate and the preliminary closing disclosure can change. Or if there's an unknown fee, for example, if you're buying a condo and we didn't know that the homeowners association charges $150 for a transfer fee. That is a legitimate change. An unknown fee is generally a legitimate change. So if their borrower requested changes are legitimate changes, and unknown fees or fees that pop up that are legitimate and associated with the processing of the loan that were unknown at this point, that's a legitimate change. But generally, the closing cost cannot change more than 10% from this point to that point. But once you've signed, the loan documents go back to the lender, and they review them, and then they push a big red button, and the money flies into the escrow company's account, and your loan is finished. So please let me know if any portion of this is unclear. Again, on my website, there's a sort of a flow chart of what the loan process is, but this is a little bit more clear, or maybe it's not so clear. But you can look at this and look at that and determine if you've got any further questions. I wanted to append this video with a little bit of more information concerning the 3-day waiting period. So the 3-day waiting period was put in place by the CFPB, or the Consumer Financial Protection Bureau, 3-day waiting period, as a safety valve for people who are buying houses or refinancing houses. As if you weren't entirely certain that you wanted to buy a house by the time you got to this point, this is your time to second guess that. But once you open or e-acknowledge the preliminary closing disclosure, that starts what's known as the 3-day waiting period. So some lenders count the 3-day waiting period on the day that you open it. Say you open it on Wednesday, and some lenders start the 3-day waiting period the next day when you open it. So some lenders, it would be Wednesday, Thursday, Friday, and then you can sign Saturday or Monday. And some lenders are, you open it Wednesday and it's Thursday, Friday, Saturday, skip Sunday because Sunday is not a 3-day period day, and then you can sign on Monday. But on a purchase, if you're purchasing a house, there is one 3-day waiting period. So let's say that you open your preliminary closing disclosure on a Wednesday. That would be, depending upon the lender, we'll call it Wednesday, Thursday, Friday, sign Saturday, and fund on a Monday, if that's what you're planning on doing. But on a refinance, it's different. It's similar, but different. There's 2 3-day waiting periods. As if you weren't entirely certain after the first 3-day waiting period, you got another 3-day waiting period. So on a purchase, it can be open the preliminary closing disclosure, 1, 2, 3, and then fund on a Monday. Say this is a Wednesday, and this is a Monday. With a refinance, you would open it on a Wednesday, and then there would be Thursday, Friday, Saturday, or Wednesday, Thursday, Friday, Saturday, and then close and fund on a Monday on a purchase. On a 3-day, on a refinance, it would be open the preliminary closing disclosure, 1, 2, 3, sign, and then wait yet another 3 days. So if you're doing a refinance, it's always important to make sure you're available to open that preliminary closing disclosure, say 6 business days before the end of a month. So I hope that's clear. Just remember that on a purchase, there's 1 3-day waiting period, and on a refinance, there's 2 3-day waiting periods. So there you have it. Thanks. Hey, everybody. I wanted to append this video with a little bit more information on the 10% tolerance rule. I've been getting so many questions about what falls into the 10% tolerance rule and what is not part of the 10% tolerance rule that I thought that I would append this video with a little bit of further information to clarify that for you. And in the other part of the video, I said that when you're issued a loan estimate, that it is an estimate of the cost of doing the loan. And when we're out of underwriting, the lender sends a preliminary closing disclosure, and you open that preliminary closing disclosure to start the 3-day waiting period. And I had mentioned that the fees from the loan estimate to the preliminary closing disclosure cannot change more than 10%. Otherwise, the loan officer has to pay for it. That is both true and untrue, and since I'm kind of a stickler for accuracy, I wanted to let you know what fees can change and what fees cannot change. So after the mortgage crisis, the Dodd-Frank Financial Reform Act, and there's 30,000 pages to the Dodd-Frank Financial Reform Act. It's riveting reading. I've not read it myself. But they divide the closing cost and prepaid items into a variety of different sections. So there's Section A, which has loan origination charges. Section B, which has services the borrower cannot shop for. Section C, which is services the borrower can shop for. And then there's a subtotal fee, or a section. And then there's taxes and other government fees. There's prepaid items, funds that go into the reserve account, and other miscellaneous fees. Usually there isn't miscellaneous, but you get the idea. And then there's a subtotal of the prepaid items, and then there's a subtotal of all of the fees. So there's three types of tolerances. There's something called zero tolerance, and that means that the fee cannot change 1 nickel from what was quoted from here to here. Then there's a 10% tolerance, and there can be 10% change from here to here in aggregate. And then there's no tolerance. So don't confuse no tolerance with zero tolerance. This means that it can change any amount. So we've put up on the screen a second page to the loan estimate, which is indistinguishable from the second page of the preliminary closing disclosure. They look exactly the same. This second page that has the zero tolerance areas. And these zero tolerance areas are Section A, Section B, and some section of Section E. It's interesting to note that the zero tolerance, you cannot change the transfer taxes. But this first document has the sections A, B, and C, or excuse me, E, that are highlighted that show which fees have a zero tolerance. Now there's the 10% tolerance rule, and these are sections E, parts of section E, and section C. And you can see that right there with that document, the second page of the loan estimate, which has the 10% areas that can't change. And the no tolerance areas are sections F, sections G, and sections H. And that makes sense because these items are items that you pay for in advance on your own behalf. And these are prepaid property taxes and prepaid insurance and prepaid interest. And we've put up a section which shows the no tolerance from the second page of the loan estimate. And you can see which sections can have no tolerance. And in the previous one, you can see which sections have 10% tolerance and which ones have zero tolerance. So I hope you found this information useful and informative. I just wanted to make sure I clarified it so there weren't any questions. So if you'd like these documents or an example of which sections have the zero tolerance, the 10% tolerance, and the no tolerance, I'm happy to send you that. All you have to do is email me. Again, I hope you found this information useful and informative. Thanks for watching my video. I hope you found it useful and informative. It's intended as a broad overview of the material so that you may have some further questions. Feel free to ask them, and I'll be happy to answer them as best I can. Share, like, and subscribe, but share it with somebody who can actually use it. Maybe someone who's going through the loan process and is a little confused. Hope they get something out of it as well. So happy viewing. There's more to the series. Hope you enjoy the rest of the videos. Thank you. And now for a quick disclaimer. So these videos are intended for informational purposes only. So don't rely on them for making important financial decisions, especially decisions concerning your housing. If you've got any questions about how this information applies to your given situation or your given transaction, please contact your mortgage broker directly, and they can give you advice. And any rate, fee, cost, or loan limit information was accurate at the time that the video was made, but may not be currently accurate because underwriting guidelines change all the time. So if you've got any questions about how this information relates to you specifically, contact your mortgage broker. So I hope you continue to enjoy the series. Thanks.